Hey guys, it's Nick, and I'm going to tell you how to make $4 billion really easily. All you have to do is start with $9 billion, give it to Verizon, and have them invest in some old ass internet stocks. So the news today is that Verizon is selling off their AOL and Yahoo units to Apollo Global Management for $4.25 billion, and Verizon is going to keep a 10% stake. Just in case something good happens from it, who knows? They paid almost $9 billion just a few years ago for AOL and Yahoo in the hopes that they were going to put these two together for some new advertising unit to compete in the online advertising with Google, Amazon, and Facebook. There are some lessons to be learned here by this big loss that Verizon is taking on these investments that they only held for a few years. Also lessons about overvalued stock. If you look at Yahoo and AOL at their peak, their combined total value was over $300 billion. So I'll look at the valuations of Yahoo and AOL back in the internet bubble and see what people were saying about it when it was really overpriced. But let's look at the lessons that Verizon learned. You can learn from this also. The number one lesson is stay in your lane. What that means is if you're good at something, keep doing that thing because you're probably better at it than most other people or companies. So Verizon is good at telecom. They have basically a monopoly in their area, or used to, from the breakup of AT&T in 1984 into the baby bells. They were New York Telephone, NYNEX, Bell Atlantic, now Verizon. And, that's what they've been doing for all these years. They're good at it. They know how to do it. Stick to that. Internet advertising is a completely different animal from telecom. To think that they're going to compete against companies whose main focus is advertising, like Google, Facebook, and to an extent Amazon, is completely ridiculous, and it sounds doomed to fail, especially when you're using these two over-the-hill internet companies from 20 years ago, thinking that you're going to catch up to these leaders in the industry. I'm not just trying to point out Verizon's mistakes, because a lot of companies do this as well, including companies like Google. They tried to compete with Verizon in telecom with this fiber project, and it didn't get very far, and it's basically throttled down or canceled or whatever. It didn't live up to the projections. It's a lot harder than they thought it was going to be, and more expensive to compete with the likes of Verizon, companies like that. And Google also tried to compete with Facebook with their social media platform Orchid, and then later on Google Plus when they tried to kind of rebrand it. Both of them didn't pan out. The second lesson to learn from this is that CEOs of public companies have no skin in the game and have no real recourse against them if one of these investments that they make goes bad with shareholders' money. So they can make all these investments and they get their bonuses at the end of the year, and it doesn't matter whether these investments pan out, especially since you're not going to know the extent of it until some few years down the line. So in this case, Lowell McAdams made these acquisitions of AOL and Yahoo, and he retired, and now there's a new guy there, and he already wrote down $4 or $5 billion of the value of these things just a few years ago. And now they're selling it, for a 50% discount. So there's not going to be any kind of clawback against the CEOs who did these deals. So shareholders lose in the end. And that's the one downside of owning stock in a public company. You have very little recourse on what they do, and the CEOs who make the decisions, they don't get punished for making a bad financial decision for shareholders. So that's a real problem. So you can start your own company, make your own decisions. You're better off. It's easier said than done, but just be aware that when you're buying stock in a company, you really have very little recourse on what the CEOs are going to do, and their pay does not reflect the bad decisions that they make. Now, the third and most important lesson from this is to look at the value of AOL and Yahoo today at $4 billion, give or take, when they were over $300 billion market cap at their peak. So here's a chart of the Yahoo market cap at its peak was about 115 billion or something like that. And just what, a year or so later, it was as low as 5 billion and, bounced back a little bit. But here in 2008, speaking of bad decisions, Microsoft was offering $45 billion for Yahoo. And the CEO at the time, the Jerry Yang, who was the founder, one of the founders of Yahoo, declined that offer. So bad decision on Microsoft's part to offer so much for a company that was around 20 or 30 billion at the time, and a bad decision on the CEO's part to not accept that offer. That's what, more than 10 times what it's worth today. And it's funny that AOL and Yahoo find themselves together because in 2010, there was reports that AOL wanted to buy Yahoo. And this is when AOL was only worth 2.68 billion and Yahoo was worth 20 billion. And so here's a look at AOL's value over the years. IPO'd at $61 million in 1992. By the time its merger, the biggest merger in corporate history, AOL was valued at $161 billion when it merged with Time Warner in 2000. By 2009, it was all the way down to being worth only $4 billion. And along the way, Google invested $1 billion in AOL for a 5% stake, valuing it at $20 billion. And just 4 years later, Google sold its AOL stake at only about a third of the value that it originally bought its stake, from 20 billion to 5.7 billion. So there's a lot of smart companies making a lot of bad investment decisions out there. Now, this is the part I want current investors to really take a look at and see the similarities and the, convincing yourself that price to earnings ratios don't matter, valuations don't matter. As long as the company has unlimited growth ahead of it, you could just throw that all out the window, especially when you see big so-called smart investors and mutual funds buying these stocks as well, like a Kathy Woods or whatever. You'll see this has been going on forever. Nothing changes, just the names change. So let's take a look at the Wall Street Journal, 1999. There's some stocks you want to buy on the cheap, then there are bellwethers you just have to own at about any price. That's the mantra of Eric Gustafsson and others like him, co-manager of Stein Rowe Young Investor Fund, threw in the towel in November and bought America Online when the stock was at its peak. He had resisted buying the stock for his $1 billion fund because it looked wildly overpriced. Its price to earnings ratio was monstrous, he says. A foolish move? Not by a long shot. Since then, the fund's 300,000 shares have doubled in value. Now we're relieved Mr. Gustafsson is a convert to internet investing. To own a company like AOL, you had to throw out traditional measures of valuing companies. Where have I heard that before? Kind of like Tesla, I think. Pot stocks, Bitcoin, I don't know, all that kind of stuff. We had to say we have to own what we think is the dominant franchise in the internet. It was a space that, as a money manager, you simply have to be in. Okay, replace internet with electric cars, and that's the same justification for paying 1100 PE for Tesla and all these electric cars now. And stop me if you heard this one. No doubt the ranks of funds owning AOL have surged this year, given that the stock was added to the S&P 500 index on the first trading day of the year. How can he justify the high price of AOL, which sells for 388 times trailing earnings or 238 times projected earnings? Well, he says that major communications or industrial revolutions such as railroads in the 19th century or radio in the early 20th century brought valuations that had not been seen before. Yes, the radio companies ultimately crashed in value, but the web has grown faster than radio or TV ever did. Naysayers have missed the fundamental shift in the US to an information economy, blah, blah, blah. So It was different back then, and just like it's different this time, right? Let's look at Yahoo, December 7th, 1999. Yahoo, which was added to the closely mirrored S&P 500 index after the close of trading, soared nearly 24% on the day, adding 67 and 3/16 to 348. Yes, that's when stocks were trading in fractions. The web portal's stock has been on a tear since last Tuesday when Standard & Poor's announced that it would be added to the index, rising more than 63%. At Tuesday's close, Yahoo shares were trading at a price-to-earnings ratio of 1,123, and the company's total market cap was more than $91.6 billion. Didn't Tesla have 1,100 PE recently? Now, this is the best part. It sounds kind of like Cathie Wood talking points on her stocks. Clearly, the stock deserves a premium, said Schroeder analyst Arthur Newman, who boosted his target price on Yahoo. What Yahoo is demonstrating with all of that traffic is that clearly advertisers do need Yahoo, but maybe not the other portals out there. Like I said, that CEOs don't have skin in the game and don't really get punished for bad decisions. That goes doubly for Wall Street analysts. This guy, Arthur Newman, if you bought Yahoo at 225 or whatever, based on his price target of 350, if you lose 90% of your money, he's not refunding any of that, and his bonus or salary doesn't change very much as long as he still has that job. Also, people have a real short memory, so there's nobody out there saying today, hey, Arthur Newman really screwed me on that update recommendation for Yahoo. So guys, big companies are always going to make questionable or bad investments because the CEOs have no real skin in the game and it doesn't hurt them financially. You, on the other hand, when you're buying these hype stocks, these story stocks that say that they have forever growth and PE doesn't matter, valuation doesn't matter, and all that stuff, if you buy that and the bubble pops, and it always does, you're going to be left holding big losses. All the internet stocks were down 90% or so, even the Amazons, the eBays, and all that kind of stuff, just in like a year or two. So you see, AOL and Yahoo were the bluest chip internet stocks. They can do no wrong. All the smartest people said, just don't worry about valuation. Just buy it, close your eyes, buy it, and you're going to make money in the long run. Look at them now. They're more than 90% down from where they were at its peak. So don't fall for that kind of hype that people are trying to sell you. Buy real companies with real normal valuations, 20, 25, 15, 30, something like that. Not 400, 800, 1100 like Tesla or some crazy electric car stocks with no profits and that kind of thing. I hope you liked this video, guys, and I'll see you on the next one. Thanks for watching.